If you've been watching real estate videos for the last 6 months and still feel more confused than when you started, I'm going to help you solve that problem. The problem is that almost everyone teaching online is teaching you a tactic. Buy a rental, flip a house, wholesale, BRRRR, which stands for buy, rehab, rent, refinance, and repeat. Everyone has a favorite. Everyone has a tactic. Everyone sounds convinced theirs is the right one and the right way to go. But what nobody's teaching you is how experienced investors actually think before they ever pick a tactic. That's the difference between people who quietly build wealth in real estate and people who never do a deal. I've been investing for 23 years. I've lived through 3 market cycles. I retired through real estate in 2022, and I still hold notes as the bank today. In the next few minutes, I'm going to walk you through the 4 shifts that separate experienced investors from the rest of the pack. I started investing in 2003. I've done foreclosures, pre-foreclosures, short sales, rehabs, rentals, wholesales, and flips. I retired through this in 2022 and I still hold notes today, which means I'm the bank on real deals with real borrowers. What I'm about to share comes from 23 years of actually doing this, not theory. Point number 1. Experienced investors make their money when they buy, not when they sell. Here's the first shift, and it's the one that will immediately change how you look at every property you evaluate. Most beginners buy a property because they think it's going to go up in value. And I understand why. It is exciting. It feels like you found something. That's not a strategy, though. You have no control over whether the market goes up or down. Experienced investors look at what a property is actually going to generate in real dollars before they ever write an offer. On a rental, that's what it pays you every month after every expense. On a flip, that's the profit built into the purchase price based on what comparable properties are actually selling for right now. Either way, the money has to be there on paper before you buy it. That's what making your money when you buy means. You're not buying and waiting. You're buying because the numbers already show you where the money is coming from. Appreciation on top of that? Awesome. But it's never the reason you buy. It's a bonus. This is where most people get it wrong in a way that actually costs them money. Let me show you what I mean. 2 properties, same neighborhood. Property A, someone tells you it's going to go up in value. It's appreciated over the years. So they just have a good feeling about it. No specific number, no plan, just a feeling. Property B, you've run the numbers. Whether you're holding it as a rental or you're going to flip it, you know exactly what it's going to generate before you close. Imagine the market goes sideways for 2 of the next 5 years. And trust me, it does happen. I've watched it more than once over the past 23 years. Property B still works because the money was already in the deal when you bought it. Property A is waiting for something that may or may not show up on your timeline. That's the shift. Experienced investors analyze what a property is going to generate before they buy it. The market moving up is just their bonus. It's never, ever the reason they buy. Point number 2. Experienced investors don't pick a strategy first. The analysis determines the plan. This next one is the shift I wish someone had told me in year 1 because it changes how you look at every single property you evaluate. Beginners pick a strategy first, then go looking for the deals to fit it. I'm going to be a flipper. I'm going to be a landlord. I'm going to have rentals. I think I want to do a wholesale. But then they try to force every property they find into that box. That's backwards. Experienced investors evaluate the property and let the numbers tell them what it should be. The same address could be a rental, a flip, a wholesale, a BRRRR, or a creative finance deal. Which one it becomes depends on the numbers, the seller's situation, and how much money you have available at that particular moment. I had this happen firsthand. I bought a property through a short sale. I went in thinking I was going to do a quick rehab and flip it. That was my plan. But here's where it gets interesting and why I still hold that note today. When I ran the numbers after the rehab, the rental math was actually stronger than the flip math at that moment in the market. So I pivoted. I held it as a rental. Then later, the right buyer came along and I structured it as an owner finance deal instead of a traditional sale. I carried the note and I became the bank on that particular property. Still cash flow, still generating income, just without all the responsibilities of being a landlord. And I still carry that note today. That deal has been significantly more profitable than the flip I had originally planned ever would have been. If I'd been locked into I'm a flipper, I would have sold it, taken the check, and just moved on. Instead, I let the numbers lead me into what the deal actually was and could be. The lesson? Don't pick a strategy and force every deal into it. Run the numbers first. The right plan will show itself. Point number 3. Experienced investors look at the worst case first. Point 3 is the one I want you to slow down on, because this is where most beginners make the mistakes that actually set them back. Experienced investors don't look at a deal by imagining the best case. They look at it by asking, what happens if things go wrong? What happens if there's a vacancy? What happens if rates shift? What happens if the market softens? What happens if your rehab costs run over? Before I buy anything, I need to know the deal still works, even if something unexpected happens. And something unexpected always happens at some point. One metric I use to measure on rental properties is called DSCR, which stands for Debt Service Coverage Ratio. I go into detail on that in some of my other videos, but the specific tool you use matters less than the habit itself. The habit is this: before you write an offer, stress test the deal. Know what your worst case looks like, know how much room you have if things don't go exactly as planned. And if the deal only works when everything goes perfectly, then it's not a good enough deal. Let me show you what I mean. Because the difference between a deal that has room to breathe and one that doesn't isn't obvious until something goes wrong. I don't buy a deal that doesn't have a cushion built in. Not because someone invented that rule, because the cushion is what I've needed more than once when something unexpected happened. If you buy a deal that only works if the market goes up and the market doesn't go up, you're going to lose money. It's as simple as that. Then you're stuck paying out of pocket on a property that isn't generating enough to cover its own costs. Knowing your worst case before you buy isn't just being cautious. It's how you stay in the game long enough to build something real. I know what some of you are thinking, and I want to address it before we get to the last shift. This sounds great, but I'm not in the market where the numbers work. Everything in my area loses money on paper. I hear you. That's a fair concern, and I get asked that constantly. The answer is still the same. You look at other markets. You look at creative financing structures that lower your monthly loan payment, or you wait. What you don't do is force the deal that doesn't work because you want to be in the game. That's how people get hurt financially. I'd rather make 0 deals this year than one bad deal. One bad deal doesn't just cost you money. It can cost you the confidence and the money to ever do another one. Point number 4. Experienced investors plan the exit before they make the entry. The last shift is the one most people skip entirely, and it's the one that has protected me more times than I can count. Before I buy any property, I need to know 3 exit options. How would I sell this if I needed to? How would I refinance it? How long can I afford to hold it if everything went quiet? I've walked away from deals that looked good on the surface more than once. You see a property, the location feels right, the seller seems motivated, and your gut says, this is going to be an easy one. Then you run the actual numbers, and the math says no. And here's the part most people don't talk about because there's no exciting story attached to it. When that happens and the math says no, I listen to the math every single time, even when everything tells me to move forward. Those aren't the deals I talk about a lot because there's no story to tell, but they're some of the most important decisions that I make. Every deal I don't do keeps money available for other deals that actually work. Every time I let the math say no, I protect my ability to say yes to something better. That's what planning your exit really is. It's not about having a backup plan for one property. It's about protecting your ability to keep investing. So know your exit before you write the offer every single time. When I retired, every property I still owned was profitable. That wasn't luck. That was the result of applying the same rules to every single deal for years before I needed those properties to actually support my life. The mind shifts I just walked you through aren't things I figured out in a classroom. They're things I figured out through 23 years of real deals, real mistakes, and real money on the line. And they're still the way I evaluate every deal I look at today. If you want to go deeper, I put together a free guide called 7 Mistakes Investors Make and How to Avoid Them. It's the same list I'd hand a friend or a family member if they asked me where to start. The link is in the description below. Grab it, look it over, and use it on your first deal or your next deal. If this is the kind of real estate content you've been looking for and not finding, please subscribe. I cover one of these mindset and methodology pieces every week, and I show the math, not just the conclusion. My goal is to teach you how to think like an experienced real estate investor. The investors who build wealth in this market aren't the ones with the most money or the best timing. They're the ones who think clearly and make decisions based on the numbers when everyone else is making their decisions based on emotion. That's the only edge I've ever had, and it's the one anyone watching this can build. Thank you for watching, and I'll see you in the next one.